little while back I said, accounts is so simple. All you need to understand is whatever happens in an organization has 4 options: expense, income, liability, and asset. Now I'm telling you, the accountants in the organization will have a tendency to put a label against each of the account heads. The label would be either of debit or of credit. How many options from this point of view? 2. Nature-wise, how many options? 4. This tells you, out of these 4, 2 must be debit, 2 must be credit. Now, in a profit loss account, can you tell me which one is debit, which one is credit? Expenses are debits and incomes are credits. And in a balance sheet, liabilities are credits and assets are debits. Now, this gives you one more insight. And what insight does it give you? It says that if both expenses and assets are debits, then in some way they must be similar. And why do I say they must be similar? Otherwise, why are they carrying the same label of debit? And on the other hand, incomes and liabilities must also be alike. Folks, right now, I want you to watch carefully the items listed on the asset side and the items listed on the expenses side. And tell me, do you detect a similarity? Pick up any expense. For example, salary is an expense. Look at any asset. Building is an asset, machinery is an asset, furniture is an asset. Do you see a similarity between a salary on the one hand and buildings and furniture on the other hand? But there must be, because both are carrying the label of debit. And the similarity seems to be, in both cases, money goes out. Let's imagine I go to the bank in the morning, I withdraw some money. And what do I do with that money? I use it to pay salaries amongst my staff. Where will it go? It goes to the expenses side. Next morning, I go to the bank, I withdraw the same amount of money, but this time I don't use it to pay salaries. I buy air conditioners for my office. Now, where will it go? This will be shown as an asset. In both cases, what happened? Money went out. But the first time money went out, it was an expense. The second time money went out, it created an asset. And tell me, what is the similarity between incomes and liabilities? Folks, if expenses and assets take money away, then incomes and liabilities must be bringing money in. If I come to you and I give you some money and buy the product that you are selling, what is this money for you? It's sales and therefore income. And next morning I come to you and I give you some more money. And you say, what do you want to buy? And my answer is, I haven't yet made up my mind. Why don't you keep this money? And by next week, if I don't confirm, you can give it back to me. What is this money now? Suddenly it assumes the role of a liability. You might have to give it back to me. Folks, the first time money went out, it was an expense. The second time money went out, it created an asset. First time money came in, it was an income. Again, when money came in, it was a liability. I told you a while ago, accounts is so simple. Whatever happens in an organization has 4 options: expense, income, liability, and asset. Now I seem to be telling you it's not that simple. It's actually twice as simple. Because broadly speaking, all transactions can be broken up into those that take money away and those that bring money in. And folks, now you appreciate if money has gone out, you no longer have to choose out of 4, you actually have to choose out of 2. And if money's come in, you have to choose out of 2.